Let's do more because still with us, Larry Adams, CIO for Raymond James Private Client Group. And Larry, we talk about the reflationary trade underway within the equity markets. Take a look at the bond markets as well. I mean, it is 11, 12 basis points on the day if you're going out long term. Is that a healthy sign of higher inflation and higher growth that we are now finally starting to price in?
Absolutely. I think that that's just a reflection that we're looking for good economic growth, as we were talking about earlier. I think one of the misconceptions out there that a lot of people have is that when interest rates go higher, that's going to end the bull market. Historically, that is not the case, because as long as the economy is going well, that should be very supportive of earnings growth. And I think that's the environment that we're in, particularly for those cyclical sectors.
Okay, interestingly, so the cyclical sectors have been getting a bit of late. Finally, certainly oil companies, energy companies leading the charge higher. But when we start to see PMIs rolling over just a little bit, as we did earlier today, and we are worried about perhaps the labor issues that seem to be coming up in the earnings statements at least, and supply chain constraints, are you worried about the economic growth? Are you worried about the cyclical play?
No, I think that all this is temporary. I think we're at the cusp of seeing everything turn around. I think as you look out, for example, over the next quarter, I think consumer spending is going to be very strong. We just had record back to school spending. I think you're going to see record holiday shopping in this upcoming season. So I think that'll be supportive. Don't forget that companies have pretty much nil when it comes to their inventories. You're going to see a massive rebuilding. And I think when that starts to happen, that's going to help them to actually maximize their sales going forward. And that'll help our earnings as well. So I'm not overly concerned about this interim period of softness. I think it's going to be more sustainable as we get through this COVID, as we go forward.
With regards to just the general trajectory of equities, at least as far as measured by the broad indexes, there's been a lot of talk, Larry, about the idea that we haven't had a meaningful pullback in this market. I think we had something like a 4% drawdown in the past couple of weeks from that all-time high, a setback at the beginning of this month, but that still didn't come anywhere close to official correction territory. Do you anticipate at all that the market needs to do that we need to see a big pullback of 5 or 10% in order to sort of reload and move this market higher? Or can it keep drifting the way it's been going?
No, I think if you just look right now, this is the second longest period of time that we've had without a 5% pullback. So if you rely on history, I think we're due for a pullback. But as we've always said, pullbacks just don't happen so you and I can get in at a better price, right? So I think as investors, you need to be prepared to act when, in fact, that does happen. And if you get a pullback of 5 to 10%, just remember that historically, you recoup those losses in about a 2-month period. If you get one that's between 10 and 20%, it's usually about a 4-month period of time. So they happen very quickly, and you got to be ready to act. And that's what we've been telling investors to be. Just be prepared to respond if, in fact, we do get that type of softness.
And responding in the equity market, because, Larry, I want to show a chart of real yields, and unfortunately they're still negative, at least on the 10-year, but it's getting less negative. We're now the least negative, I guess you could say, going back to July. Romain's chuckling at me because it is a brutal chart, but could you say that financial conditions are still easy? I mean, what are these sort of negative 90 basis point on the 10-year real yields telling you?
Yeah, I still think it's very easy money out there. As you mentioned, the financial conditions have been above where they were pre-pandemic for 5 consecutive months. That just tells you how easy economic conditions have been. And I think that's why it's been very warranted for the Fed to cut back on their bond purchases. I think it's important to recognize that they had 4 goals that they wanted to accomplish, right? It was narrow spreads, increase confidence, reduce volatility, and increase asset prices. And if you look at all 4 of those goals, check, 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 they've accomplished all of them. So I think it was time for them to pull off some of that uber accommodative policy. And I'm not worried that you're seeing just a minor blip in being less negative from a real rate perspective.
Larry, how are your clients sort of buying your optimism? Are they going out there and thinking the only way is up? Any cash that I had on the sidelines, I can see earning nothing, I need to put it in equities?
Yeah, so for the most part, we always talk about if we do get this type of volatility, the most important thing is not to overreact. Like Monday, one of the things that was very important, you don't want to overreact and have panic selling, because that can really damage your performance longer term. But if you see this volatility, we talk about maintaining your equity exposure. But if you do have cash, as you just mentioned, that's a time period that you probably want to put it to work. And we've seen a lot of that money go into work, because right now, as you've mentioned, after inflation, after taxes, you're not getting much keeping it in cash right now. So I think we continue to put it to work.
All right. Do you worry at all, Larry, at all about some of the stuff coming out of Washington, whether it's the additional fiscal spending, whether it's the potential for higher taxes? Any of that give you any sort of worry?
So again, historically, this is a lot of myths that are out there. I call them misplaced myths. And people worry that if you get increased taxes, it's going to be the end of the bull market. Again, historically, if you do the homework, that has not been the case. Now, that's done with the caveat that the economy remains strong, which we do believe that it will be. As far as the fiscal stimulus, I think it's, you're fighting two things here. Number one, is it lower in the size, which means we have less tax increases, or is it higher in the stimulus and then we get slightly higher taxes? I think that that's a wash for the market. I think if there is any type of upside risk, it's that we get a lot of this spending with very minuscule tax increases, and they decide to go down the route of just deficit financing. That would be more of a near-term catalyst to upside for the equity markets.